first of our National Partners Series, a series of online events where federal organizations which run programs that are relevant to our industry are giving an opportunity to share information with businesses and with their partners. We all know that the Government of Canada has many programs and type of support, but it can be challenging for businesses to figure out where to go and who to reach out to. And this is why we created this series of events. Our events are also meant to make the best use of your and the presenter's time and can run anywhere from 30 minutes to an hour. Our model is very simple. We provide the platform, open the floor to your questions, and put you in touch with presenters so you can connect directly as desired. Today, we're very pleased to host our very first National Partners Series guest, Lyndon Holm, Vice President of Corporate Financing at BDC. But before passing the mic to Lyndon, I will ask Phil, DAIR's Director of Operations, to tell us about a few housekeeping rules. Phil?
Well, thanks very much, Maurice, and I echo Maurice's welcome to all of you. Just before we hear from Lyndon, a few small housekeeping items for our webinar today. We do ask you to keep your microphone on mute as Lyndon walks through his presentation. But if you so want, please feel free to keep your camera on. We will be having a Q&A session afterwards, hearing from Lyndon on any of your questions. Please feel free to either use the chat function or the Q&A function of Teams, but also if you prefer to ask your question directly, once Lyndon finishes his presentation, we'd ask that you come on screen and you can ask directly. You'll notice that we're also recording today's session, so it will be available afterwards for yourself and your colleagues. And we'll also be making the slides available that Lyndon's walking through to all of our participants of today's webinar. So with that, I'd like to turn the floor over to Lyndon Holm, who we're very excited to have with us and hear about the BDC offerings. Lyndon, over to you.
Super. Thank you, Phil. Very happy to be with everybody this afternoon. And just quickly, in terms of my background, I've been with BDC for the last 22 years, 26 years in the industry. Since 2019, I've been looking after the aerospace and aviation and space strategy for BDC. So I've been working in the sector when times were good, and also obviously through the period here where it's been very challenging through COVID. So without further ado, I want to just give you an overview of what we're going to be talking about for the next 30 minutes or so. I'm going to talk to you a little bit about who BDC is, a little bit about how we support the aerospace sector. I'll give you a look into how we structure transactions in terms of a few examples and scenarios. I'll also talk a little bit how we can help you guys succeed out there in the market with services beyond financing. And then we'll wrap up and have an opportunity for some questions after that. So in terms of BDC itself, we've been around a long time, over 75 years. We've had different names over the years, everything from the Industrial Development Bank to the Federal Business Development Bank to, after 1995, our current version called the Business Development Bank of Canada. We are a federal crown. We're self-sustaining, so we have our own board of directors. We are profitable. We typically kick back a dividend to our shareholder. And I'm proud to say that we are we are the only financial institution in Canada that is B Corp certified. And B Corp companies, there's about 100 of them in Canada, focus on a very high standard of purpose and also social and environmental performance. We operate with a high degree of transparency and accountability. So that's something we're certified for, similar to a LEED certification for a building. This is the certification that we've pursued for BDC. Just to talk a little bit about what we look like. We have over 100 business centers that are located across the country. We have over 72,000 clients today, 2,500 employees. We operate with a very high level of client satisfaction. We are solely dedicated to the support of entrepreneurs, whether you're large or small. We support everybody. And in terms of the aerospace and aviation sector in particular, we have a portfolio hovering anywhere from 300 to or more clients, depending on who comes on board, who pays out through normal repayment. We typically would do 100 to 150 million in new loans to strictly aerospace and aviation companies every year. So that gives you a little bit of a picture about what we look like. In terms of what we put forward and we help entrepreneurs with, we do many different things. You see a list here in front of you. We handle everything from buying businesses, investing in new real estate, purchasing land, building equipment, helping companies export into new markets. We help startups. About 10% of what BDC does is pure startup financing to support Canadian entrepreneurs. And I want to give you a few examples about how we do that later on in the presentation. So in terms of how we look at aerospace and support aerospace, we are very uniquely positioned to help the sector. I have a team of champions that are located across the country, Quebec, Ontario, Vancouver, Prairies, you name it. And they're experts that have specific knowledge on how to finance into aerospace companies and also to look after specialized financing for things like aircraft. So we do both, and we do it a little differently. And I'll talk about how we offer high leverage financing to support asset acquisitions. We tend to customize our terms and conditions to suit the situation for the entrepreneur and their partners. And we always operate with a complementary mindset in mind. And the reason for that is we do not take care of all of the needs of an entrepreneur in terms of day-to-day banking, lines of credit, and other services provided by the major banks that are in our market. In terms of what makes BDC a little bit different, I'm going to start with the big one. And that is that we are a non-demand lender, similar to our sister crowns, EDC or FCC. When we get involved with an entrepreneur, it's with a very long-term lens. So we're taking a look at getting involved for a 5, 10, 15, 20 year or beyond horizon when we work with entrepreneurs. That is different than chartered banks and other lenders out there that operate on a demand mentality where they renew your credit facility every year. If trends are going wrong in your industry, they can decide to ask you to take your business elsewhere with 30 days notice. So BDC is more of a long-term partner. Our facility, as long as you're not in default, stays out for the entire life of the loan. We always offer customers the ability to prepay our facilities without penalty, which is a nice feature. We also are very patient when we start our loan repayments. So when somebody gets involved with us, and let's say you buy a building, we don't want you to start paying back the loan for that building right away. We try to give companies, depending on their situation, 6, 12, or even 18 months to start the repayments back on the facility so that they can use that asset to start generating cash flow and grow their business. We do offer, and we are very unique in the fact that we can offer long-term interest rates. And right now, interest rates are the hot topic for most entrepreneurs right now. Are they going to continue to go up? Are they going to stabilize? Are they going to eventually come down? We offer our clients up to a 25-year fixed rate, and most financial institutions only offer 2, 3, 5, 10-year type options. BDC will go as long as 25 years. So most companies work with us as a matter of diversifying their lending relationships. Many don't want all of their eggs in one basket, is the saying, where you have your line of credit, deposit accounts, and your term credit facilities for land, building, and equipment with the same institution. BDC helps stabilize credit structures by having another party and another voice at the table when maybe things are going wrong. So in terms of what we do, we can offer credit facilities of up to 100 million, and I don't want to scare anybody on the call with that number. We do loans as small as $10,000 all the way up to $100 million. We deal with companies that are startup. We deal with companies at all stages in the life cycle. You know, obviously, when you're more mature, that's when you would get into credit requirements that are in that range of $100 million. We do offer high leverage on financing for fixed assets, construction equipment. We do customize terms and conditions in all cases when we work with somebody, so that everything we do works for you as the client, and also for the partner or charter bank that's offering you your line of credit and deposit account services. What we have are some distinctive benefits that we offer. I've already mentioned the longer term committed facilities up to 25 years. That's typically real estate loans. Equipment loans are typically done between 10 and 12 years. We do offer up to 100% financing of assets for both real estate and equipment. Sometimes with equipment, we'll even go to 125% financing to help you with installation and soft costs, which can be material depending on whether or not your equipment is specialized. And we do not shy away from those types of specialized projects. We try to look at the end game and the benefit to the business of making those investments. We also offer other services like equity takeouts against assets that maybe have been paid down or increased in value over time to help bolster working capital of a business. Again, we do offer longer initial payment deferrals so that we can get you into the new building or get you using new equipment before you have to start repaying loans on it. So I want to delve into a little bit about how we structure different transactions for different needs or purposes. And the first case study I wanted to just give you is one that's for real estate. And what you'll see that's unique here, this example is for an aerospace manufacturer that was trying to grow geographically, moving and creating some physical presence in the United States, acquiring a facility for $10 million. They were also buying some additional property in Canada. This company, an example, is a US revenue company of 100 million, but you could have a similar example for a company that has 3 or 4 or 5 million in revenue, as long as you're looking at a suitable sized asset for your business and your growth opportunity. So this shows that that BDC can reach into the United States to follow our clients with their growth plans and finance assets in the United States. Other institutions, depending on whether or not they have subsidiaries in the United States, often shy away from financing these types of assets. BDC, we want to follow our clients down so that they can grow their business. And in this case, you'll see the other unique aspect is this is 100% financing of that US asset of $10 million, 100% financing of the Canadian asset for a total of $12 million. How we were able to get to 100% financing a foreign asset is, in this case, we were wrapping the existing equity in real estate that was held in Canada. And that's a very common structure to get higher leverage when you're moving into an international expansion. I will note that BDC has the ability to lend directly to a US company with a standalone credit facility, or we can lend to the Canadian company with a guarantee from the US business to get the project completed. The latter is much simpler than the former because of tax implications for both the borrower and for BDC lending internationally. So we are experts in that area, and we can give you guidance on an expansion into the United States. The second case study that I wanted to highlight is one around equipment. So this is obviously very common for aerospace companies and other manufacturing businesses or service MRO facilities. Again, you'll see in this example a company that, you know, is a reasonable scale at 150 million, but obviously we offer these services to and these types of leverages to any viable business that is seeking to grow. And there, in this case, a $15 million line of credit for purchasing equipment was what we were putting forward. And this type of facility is a little unique in that it's available and open to the company for a period of up to 2 years to draw down for future CapEx expenditures. So it's very flexible that it can be paid up or paid down through acquisition or disposition of equipment over a 2-year lifespan, and then it gets termed out for 6 years at the end of that 2 years, and you start your repayment. So it's really interest only for a 2-year period while you're buying the equipment, while you're installing the equipment, and making it work for you. It's definitely a solid option for growing companies where you haven't identified necessarily the model or make of the equipment or the manufacturer of the equipment that you want to proceed with, but you know you have a requirement and you know your horizon for that acquisition is in the next 2 years. So very unique there. And in this case, we know that this company was buying very specialized equipment. So this is stuff that is almost attached to the foundation of the building or embedded, very difficult to get out of a building if in the event you had to liquidate it. Many banks will shy away from those types of structures or situations where maybe there's not a good resale market for a piece of equipment or it's hard to remove. BDC, we try to look at the big picture and the life of that asset and whether or not we could sell that asset in place or in block in the event something went wrong. So we try to be more flexible and more open to those types of situations. One thing I didn't mention that on the previous example is that we do loans in both Canadian and US dollars. So you can actually purchase any equipment in US dollars if it makes sense for you, or leave it in a Canadian dollar loan facility. The last example I wanted to share is a little bit more of a creative example, and it's designed around working capital and bolstering the working capital of a business. And in this case, it's a supplier to an MRO operation and revenue size around 30 million, seeking inventory to support growth. And in this case, their growth plan was to grow about 65% year over year. And to do that, they obviously had a heavy working capital requirement from their operating lender to increase their line of credit facility, but also had a gap that they couldn't meet that they needed to take on additional financing for. And the ask was $2 million in this case. So this type of credit facility is very unique in that it's an unsecured facility. It sits behind any security that you've pledged to your chartered bank for a line of credit or on equipment loans or real estate loans. And it's repayable over a 5-year period, and you can do an initial postponement of up to 1, sometimes 2 years with this type of facility, so that again you're able to roll that working capital money for inventory multiple times before you have to repay the whole loan facility. It's a little bit more expensive type of capital, but than a regular secured loan, but it's also not as expensive as equity or other instruments that are on the market. So it's quite useful for many companies. And I will tell you that through the COVID crisis, many aerospace companies, aviation companies approached BDC for working capital, and we did a lot of facilities of this nature for those companies to help them bridge through a very difficult period of time. Traditionally, when you do a loan of this nature, you need historic cash flow coverage to make the loan. One of the unique things about this specific example is that this company had a bad year in 2022, and we are lending on the forecast 2023. And our analysis focused heavily on the contracts they had in place to support the fact that they could repay this loan in the future. So many banks struggle with looking beyond the historic results of the company and where the business is going. BDC is one of the few organizations that will take a look at where you're at today and help you plan for tomorrow. And we may help you get into a facility sooner than you would otherwise be able if you had to rely on just historic cash flow versus a forecast. So that's something I'd like to emphasize for everybody on the call today. Basically, we are here to help you succeed, and we're more than just a bank, and we try to be more of an advisor to our clients. And in that regard, we do have an advisory arm that offers many different services that are designed to help you address problems that keep you up at night. And those problems could be around driving sales growth. It could be productivity related, technology related, or online sales related. We offer things like lean manufacturing, where we'll help you improve and eliminate bottlenecks in your processes. We'll help you with plant layouts. We'll help you get certified for ISO, for example. We will help you with core safety certifications if you have issues around safety in your business. We'll help you bring in a new inventory management system and integrate it into your business successfully. One of the most common things we are dealing with today, it's a very appropriate subject, is cybersecurity. Many clients don't have systems or contingency plans in place for if they have problems with being hacked or other things like that. So we will actually come in and help you set up processes to minimize the risks of the damage that can happen from a situation like that. And I would say at a high level that BDC has actually done studies of its own client base, where companies that have invested in themselves and invested in dealing with their biggest problems have enjoyed a faster rate of growth and top line revenue, and have also enjoyed stronger margins. So there is some benefit to the entrepreneur for investing in themselves and in terms of their long-term success rate and growth and profitability. I'm going to touch on two other areas of our bank that, these are, more for information. If you need any further details, obviously reach out to me and I can give you more context. But I mentioned the working capital loan that was unsecured to $2 million. Well, if you have credit and capital requirements for growth around mergers, acquisitions, where there's no assets, or large transition projects where you're changing business lines and pivoting your business, or you have a growth project that you can't, isn't going to be backed by a significant amount of assets, we can do credit facilities up to $35 million that are non-dilutive to your equity or to your ownership of your business, but will give you growth capital over that can be often very flexible in repayment. It's usually up to 5 years, and sometimes you don't have to make any principal payments for 3 to 5 years and a bullet at the end. So very patient, very creative type of capital to support the growth of your business. It's obviously a more expensive type of capital, but it is an option for certain scenarios where you're looking to fill a gap between what you can obtain financing for on assets versus your need to maybe acquire a business. Lastly, I'll touch on venture capital. So venture capital is a bit of a unique investment for BDC. We focus on areas in the IT, energy, clean tech, and healthcare sectors. Aerospace is covered off by one of our funds in our venture capital group. We are looking for very particular projects where that can be scaled easily, have a huge market potential, have huge earnings potential, and top line sales growth. Very, very selective when we make investments in venture capital, but I wanted to make you aware that it is something that we do, and we are one of the largest, well, we are the largest venture capital player in Canada. So we have a material presence in Canada, not only in direct investments, but in investments between funds to other funds, as they say. So just to wrap up the presentation, we're a trusted partner out there, been around a long, long time, very patient, a good partner to diversify with in terms of your growth strategies. We tailor everything to make sure that it works for you and for your other lenders and partners and stakeholders. And certainly we can help you, as you can see, at any stage in the development of your business in terms of your growth plans. With that, Phil, I'll maybe open it up to questions if anybody has anything for me.
Well, that's fantastic, Lyndon, and really appreciate the overview and a lot of material, a lot of opportunities to work with BDC. So I would remind everyone. So please feel free. You can use the Q&A function, or if you wanted to come on screen and ask your question live to Lyndon. I might kickstart things from a Q&A, Lyndon, and maybe ask you if you could explain a little bit the application process to BDC for any of these kind of areas of financing, and maybe even is there a difference or a change in the application time frame, the approval time frame when you're applying for real estate financing versus equipment support through the BDC?
Super. That's a good question, and I would say this: it depends less on the nature of the loan, whether it's land, building, and equipment or working capital. It depends more on the size of the loan. Very small loan asks 100,000, 150,000. They can be processed almost automatically these days. When you get above those thresholds, the process is about 2 weeks from the time that the BDC or another lender receives all of the financial information to support your financing ask. And I would say that there might be a week to gather preliminary information to get you a term sheet out outlining what BDC can put forward. And then from the time you sign that term sheet to the time you provide all the information required in support of the request, it's about 2 weeks to turn that. And then from there, you get into your legal and funding. So.
That's great. So, I mean, a very kind of efficient turnaround cycle with from the application all the way through. Excellent. And again, maybe regardless of category, as companies are looking, you were talking examples of up to 100 million, all the way down to maybe 10,000. Can you maybe just talk about any minimum requirements for a company in kind of applying, number of employees, minimum revenues, years of operation, maybe just kind of a baseline understanding of minimum requirements for a company looking to apply for BDC support?
Yeah, I would say that most lenders, and including BDC, would say that a business is in a startup phase if they have only, let's say, 1 to 2 years of earnings. BDC sort of will treat you like you're not a startup after you have a year of financial results demonstrated by an accountant prepared statement. Some banks like RBC, for example, would probably want to see a longer track record, maybe even 24 to 36 months before they would treat you a little bit different than a startup. And I would say this: if you are in a startup phase, BDC typically will lend $1 or $3 for every $1 that you put in towards your startup as an equity investment. So we look at the viability of that project in terms of the business plan, what the entrepreneur is trying to accomplish, who they're trying to serve, what needs they're trying to meet, and then we'll base a decision and support off of that. If you have existing cash flow, things are a little bit easier when you can cash flow the loan you're asking for. but that isn't always the case when you're trying to grow your business, where maybe your balance sheet or your income chases your growth plans, and that's where you need a bit more creative approach and bank like BDC.
Great, thanks, Lyndon. And just a reminder, feel free to just unmute, come on camera, and ask a question or use the Q&A function. You'll notice that I also posted, and as a reminder, that the slides will be available after today's session. So just as people might be so we do have a question that comes through from Simon. Thank you, Simon. What about personal guarantees, Lyndon?
Super. So depending on the type of leverage that we will do on, let's say, a land, building, or equipment purchase, if we're doing 100% financing on those, and we're dealing with what I would say a small to medium-sized business, so maybe not the scale of the examples I gave on the call of 100 million plus, you might see a 10 to 25% personal guarantee from somebody like BDC on a leverage scenario. If you're under a secured scenario, maybe we're doing 75% to 85% financing, we may ask for no guarantees at all. It is case specific. It's based on the industry, based on the risk of that entrepreneur. And there are many cases where groups are strong enough where we would support them with no personal guarantees, even at larger lending limit levels.
Great. Thanks, Lyndon. And maybe getting into another question that's come through the chat. I know we spoke a little bit about the application, but could you kind of walk us through at a high level the application steps? I know with you presenting, you're kind of a key point of contact, but the second part of the question is, should we get directed to a BDC associate to find basically the appropriate channel for a specific company's plan?
Yes, and I would say the best course of action would be to reach out to me. And the reason for that is depending on the level of your ask and depending on the size of your business. And if you're in an aerospace sector in particular, I have a very vested interest in making sure that we're connecting you to the right resource to address your requirement, because I will say this, because this is a specific focus for BDC, we will take a higher level of risk for companies where we believe in that management team or that business plan. So if you go through a regular route, you just phone the 1-800 number or you make an application online, you're not necessarily going to patch into that expert, and they're going to give you the right guidance, and maybe the requirement can be handled through an online channel if it's very small. But if not, we typically will come out to the business, we'll come out and meet. We'll come out and sit down with you, and we'll try to determine how we can help you. And if we can't help, we're going to give you guidance as to where we think you can get that help and what you need to do and what steps you have to take to prepare yourself for getting the right outcome.
Great, and that's why we're very excited to have you in front of the companies today as a great point of contact. And of course, as a reminder, Lyndon's contact information will be provided to make sure you're able to access and connect with him. Over in the Q&A, Lyndon, we had a question. Do startup companies that are publicly traded and in the pre-revenue or early revenue generation stage qualify for financing?
The answer to that is yes. We deal with many junior publicly traded companies. Typically, the credit requirements are large if you've raised capital on the public markets. In those situations, we will typically look to be secured. And often that might look like a 50 to 75% maximum LTV, depending on the specialized nature of the assets the project that you're undertaking. The fact that you would be a publicly traded company would give some comfort that there's an ability to raise additional equity if necessary, if something goes wrong. So we try to partner with management teams and with companies that have those resources to continue to invest in their success and alongside of us, because we're not going to take all of the risk for the publicly traded company, right?
Great. And So yeah, continue to send in your questions or come online and ask directly. I do have another one that I have here, Lyndon. Obviously at DAIR, a key part of what we do is push and promote and facilitate collaboration and partnerships and joint ventures and collaborations, whether in the R&D or the supply chain side of things. From BDC's perspective, is there a value in having applications submitted as either a joint venture or a teaming agreement, basically multiple parties coming in together to strengthen chances of approval or the project in BDC's eyes?
100%. What we see a lot of could be joint ventures, could be limited partnership structures where there's a pool of investors bringing forward capital to make a project move forward. There could be a strategic investor or partner that's coming alongside of you on a project. There could be Indigenous or First Nations that are coming in as a partner to make your project more viable or to support the local community. So I would say all of the above, and some of those partners can bring significant strength and benefit and integration, maybe vertical integration into a proposed project. And we tend to favor those situations more than when you don't have that fully thought out or in your plans.
Great. So we still have time, so I still encourage you to send through your question if you have one now. I did want to touch on, and Lyndon, we've spent I would say most of the time talking kind of about the financing side, but in your presentation you brought up the advisory services and the role BDC does in that regard. Can you just maybe speak to what kind of arrangement or fee structure would be associated with kind of the advisory services? Obviously each situation would be unique, but maybe you could speak in general terms to the fee structure and negotiations on the advisory side.
Perfect. So our advisory services are designed to be on a cost recovery basis. And when I say that, we actually don't recover all of our costs. So it's a bit of a loss leader for BDC, but we try to fill a gap in the market between the KPMGs of the world or the McKinseys of the world they're dealing with large contracts for companies, and they bill out at large rates. So BDC tries to provide a service that's a mid-tier service. So it's not at the at the quality level of an independent consultant or at a cost level of an independent consultant. It comes in a mid-tier where we have a standard methodology we employ. We have fully trained roster consultants that work with our methodology to deliver solutions to entrepreneurs consistently. And we stand behind and guarantee that outcome. And if something's not working out, we'll step in. We'll try to make an alternate arrangement, bring a new consultant or advisor in if things aren't working out, or both parties change priorities and part ways. So we're there to use those services to help you scale your business and grow it, not to make a profit off of those services.
Great. Thanks, Lyndon. So I've just been checking. Oh, there we into the chat. Sorry, I go. Can we and Lyndon, my apologies. I'm trying to get over to the chat. I've been looking at both the chat and the Q&A, but can we talk a little bit about the specific advantages of kind of the working capital loans for the aerospace companies by BDC?
Yeah, I would say that the smaller working capital example I gave, or case study I gave, up to $2 million, that's a very attractive type of working capital for a company because it's non-dilutive. You're not giving up any ownership. There's no convertible debentures or anything fancy in it. It's basically a straight term loan, 5 years plus an initial deferral. And the cost of funds on that, range from 8 to 12% at today's rates. Obviously, rates have gone up significantly over the course of the last year. And if you get into higher threshold asks or fully mezzanine capital, the costs jump up even further than that. It can be probably up to 30%. And when you get north of 30%, then you're into equity investments, and those can be quite costly depending on how much ownership of your company you're giving away. So our working capital loans are designed to be complementary to what you can get from your chartered bank for your line of credit. And maybe they can't quite get to what you need. Maybe you need 3 million, maybe they can only get to 2. Then we come in and we give you the other million to get to 3 million using this non-dilutive working capital. And that's supports the bank, so they're happy we're coming in and giving some capital, which benefits you and them in terms of their security position, and you in terms of the extra money. So that's the way it's designed.
Great. Thanks so much, Lyndon. Some really good questions that have come through. So just kind of taking maybe a last look through if there's any final questions as we get near the end of our time today. I'm not seeing any. So maybe just noting that I think we can always connect, and questions afterwards can come to us at DAIR or through to you, Lyndon.
Absolutely.
I wanted to remind everyone on a few items. Of course, the slides, the recording of today's session will be available. We'll make sure that Lyndon's contact information is available, and I know he'd be happy to connect with you or your colleagues. And I would say that DAIR is also would be excited to connect with any and all of you as well. So in the chat, the slides will actually be sent out to all the participants by our colleague Samantha Glover. So that will be coming later today. And Lyndon, I believe that your contact information, we'll send it in the email, but it's also in the slides. So
right on.
Melise, over to you for any last words.
Yeah, a big thank you for this, Lyndon. Much appreciated.